First of all, why are diesel prices still so high? We haven't really seen them ease yet.
Well, because the demand is out there, quite frankly. You're not seeing an ebb off in the demand for diesel to the demand for moving freight. And therefore, with demand strong, prices are going to stay high.
There's been this decoupling effect a little bit from gasoline, and I don't know if it's going to continue. But to your point, Donald, what does it mean for truckers who are facing now the prospect of a lot higher fuel costs? People have raised the kinds of protests we've seen in recent decades over similar problems, saying there were times that people would literally stop driving trucks. They would, shut down routes. They'd go out of business. I mean, we've already had such a supply chain problem. This now adds another element to it.
It certainly does. And it's certainly pinching margins for all truckers. What happens is if you look at any level of diesel prices, the fuel surcharges that are in place, those programs essentially completely offset the incremental cost. But there's a lag because you're paying the price at the pump today, and that price has been going up, 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 up. And the fuel surcharge resets once a week, and it's based upon last week's average price. So there's a lag and there's a catch up. And so you get a lag, a shortfall on the way up. You get a windfall on the way down, but you got to weather through that period, first of all. And as you pointed out, Kelly, we've never seen this big of an increase in such a short time frame. We saw literally a $1.20 gallon jump in the price of diesel in just 3 weeks.
Wow.
And we're at prices, 65% above where they were a year ago.
Let's talk stock impact. There are a number of publicly traded names involved here, but as you know, it's the smaller players who will be hit the hardest. They have fewer resources to deal with it. What does it mean for Knight and Schneider and Werner and J.B. Hunt?
Well, for Knight, Schneider, Werner, those are big fleets. They're going to certainly have those short-term headwinds of playing catch-up on it, but it's going to be a bigger headwind for their smaller competitors. So in the grand scheme of things, they'll weather through this. Decent balance sheets, good operating fleets, et cetera, and they buy at bulk rates. So they're going to escape the pain that the smaller guys are going to suffer full on. Hunt's is a different story. Remember that Hunt is the largest truck to rail to truck, what's called domestic intermodal player in the U.S. And sure, they have a truck division which will get hurt just as Knight and Snyder and Werner's will. But their truck division is 7% of their revenue, 6% of their operating profit. Their intermodal business is 45% of their revenue, almost 60% of their operating profit, and that part of their business is doing extraordinarily well right now because you can save yourself as a shipper the higher fuel surcharge cost by switching to that domestic intermodal, and so the customers are beating a path to their door as a result.
Shepard Smith here. Thanks for watching CNBC on YouTube.